Welcome to Prompt Your Life. I'm Christoph Theodor. And today we are breaking down the critical intelligence and high stakes moves shaping this landscape.
Methodical. When two publicly traded companies post identical quantitative earnings surprises, traditional theory suggests the results should be parallel. In practice, however, identical fundamental data frequently produces vastly different market reactions. Financial models often assume that hard numbers are the supreme driver of price discovery. A positive surprise is expected to compute into an immediate upward price correction, unencumbered by human interpretation. This plot tracks that empirical failure. We're looking at two identical positive earnings surprises. Instead of parallel momentum, the trajectories diverge. One adjusts instantly, the other lags. This delta between expected and actual adjusted price is the earnings response coefficient, or ERC. The divergence in the ERC proves that quantitative data alone is structurally insufficient to predict immediate market reactions. A hidden variable is generating friction in the pricing mechanism. To locate that friction, we have to examine the quarterly earnings conference call, the precise informational environment where price discovery occurs. Textual analysis allows us to unpack the qualitative data transmitted during these calls, turning spoken words into a quantifiable data set. The central thesis is that executives possess persistent communication styles. These patterns act as a latent variable that influences how the market prices a firm. The critical variance measured here is the executive's reliance on vague, uncertain language during their delivery. Managerial vagueness creates systemic friction. It actively dampens the ERC and suppresses the abnormal trading volume that typically follows a major earnings beat. Executive language functions as a discount rate, applied by the market in real time against quantitative earnings surprises. To measure this effect, we first have to define what constitutes vague terminology in a formal financial context. This transcript identifies the target data, weak modal or qualifying words. Terms such as approximately, probably, or maybe are isolated from the surrounding text. Researchers use the Laugren and McDonald Uncertainty Dictionary as the academic benchmark for categorizing these specific terms. By cross-referencing transcripts with this dictionary, we calculate the percentage of uncertain words against the total volume of words spoken by the executive. This metric allows us to mathematically plot an executive's linguistic clarity versus their level of obfuscation. Converting subjective speech into a strict objective percentage is the mandatory prerequisite for economic modeling. However, we face a core analytical challenge. We must separate an executive's personal style from the firm's mandatory corporate messaging. Standard analysis is often confounded by firm-level crises or macroeconomic shifts that could make any executive sound uncertain. To filter this out, we use the structural format of the conference call as a natural control environment. This diagram splits the call. The scripted presentation reflects corporate culture, while the improvised Q&A reveals personal style. Regressing Q&A vagueness against the presentation baseline and controlling for analyst tone isolates the fixed effect, the pure variable for managerial communication style. This mathematical isolation provides a method for identifying stylistic differences as properties of the individual executive, separate from the corporation they lead. We must now ask if these stylistic differences are merely the result of industry-specific jargon or age-based demographic cohorts. To test this, the style extraction model was applied to a dataset spanning 48 pharma-French industries. This figure shows the distribution of CEO vagueness across industry box plots, confirming massive heterogeneity regardless of sector. Notice the wide interquartile ranges. The variance in vagueness within one sector is significantly larger than median shifts between sectors. Executive communication style is a highly individualized trait. It travels with the person and remains independent of their operational sector. With the style variable isolated, we can connect it directly back to our initial problem, the earnings response coefficient. We run a regression analyzing cumulative abnormal returns against the extremes of executive vagueness. This chart demonstrates the primary finding. As executive vagueness increases, the slope of the abnormal cumulative return trendline flattens. The data highlights a 26 basis point reduction in returns between straight-talking and highly vague executives. This dampening effect is most pronounced when observing large-cap equities trading within the S&P 500. Straight-talking executives operating within these large-cap firms generate a roughly 13% higher earnings response coefficient than their vague peers. High managerial vagueness also has a secondary impact on the investment community, delaying analyst forecast revisions and suppressing trading volumes. Market participants actively discount vague information, proving that linguistic style carries a measurable penalty on price discovery. These results challenge the substitution hypothesis, the common belief that hard numbers completely override soft managerial tone. The evidence presented today refutes that assumption. Markets do not substitute numbers for style, they rely on both. This points to the complement hypothesis. This map shows how quantitative data and straightforward contextual information function as co-requisite complements. Both are required for optimal market integration. Vague communication creates an opaque environment, making it difficult for the market to seamlessly price even the most positive earnings surprises. Stylistic friction alters the speed and accuracy of price discovery. This carries broad implications for corporate governance and board-level hiring. Executive selection is the appointment of a leader, but it is also the acquisition of a specific structural communication style for the corporation. Individual managerial vagueness is a persistent, quantifiable variable that dictates the ultimate efficiency of a firm.
Disclaimer: the content on this channel is for informational and entertainment purposes only. I am presenting my personal investments and strategies here as part of Prompt Your Life. This does not constitute investment advice, a recommendation to buy, or financial analysis. Investments in the capital market are associated with risks. Always act at your own risk and responsibility.